Can I invest my company cash into stocks and shares or other investments? This is a question that I'm often asked by clients seeking higher returns on their company's excess cash than they might otherwise achieve through a business bank account. Often, business owners will build surplus cash in their business that they don't want to extract due to the personal tax that would be incurred if they withdrew this as a dividend. So, some of them attempt to put this to work by making investments within the business itself. There are a few traps to avoid and some considerations to think about here, including the misconception that I see quite frequently that making investments is a tax-deductible business expense for the company. So in this video, we're going to cover a few things that you need to know or that you should be thinking about if you're going to be investing your company's cash into the stock market or into any other investments. On top of this, we're going to look at two alternative methods of putting your company's hard-earned cash to work. Before we begin, hello, my name's Joe. I'm an ACCA Chartered Accountant and founder of E-Commerce Accountants, the UK's leading accountancy for e-commerce businesses. You can find out more about myself and my company in the details below. So let's answer the question. First of all, can you invest money from your company into things like stocks and shares, cryptocurrency, or any other investments? The simple answer is yes. There is nothing stopping a UK limited company from making an investment. However, as I mentioned earlier, there are a few considerations that you should think about before doing this. Firstly, let's look at some of the tax risks and implications of investing company money into the stock market. Number one, your investments are not treating as a trading expense. This means you do not benefit from corporation tax relief on your investment. Instead, whichever securities or assets you've bought, they'll sit on your balance sheet as an asset until effectively you sell them or divest. Number two, when you sell the asset, you will pay corporation tax on those gains. However, when we compare this to individuals, you would usually pay capital gains. And unlike individuals, companies don't then get an annual exemption or different tax rates for capital gains. This usually makes it more efficient or more tax efficient if you're an individual making an investment rather than a company. As a side note here, there used to be something known as the indexation allowance, which was given to companies. This increased the base cost of an investment based on inflation. However, this is no longer the case. In other words, it used to be debatable as to whether or not it was more tax efficient or better to invest as a company. But now, investing is far more favourable from an individual point of view. Number three, your company is able to make an investment before you pay income tax, meaning that the amount that you're making is usually grossed up, which means that this is going to be higher than if you invested personally. So while there are no individual allowances available, and while capital gains taxes are higher, well, they're lower than corporation tax, but they're effectively higher for a company, so the tax paid is going to be higher. Any gains are likely to be higher as you're typically investing much larger amounts because they're sort of coming from a bigger figure. Number four, the rules around losses in companies are much more technical. So if you make a loss when selling an investment, you cannot use it against your regular trading profit. It can only be offset against gains from another or the same investment activity. Number five, there are differing accounting rules for investment companies versus trading companies. A trading company is one that's carrying out a trade. For example, an e-commerce or a retail business. This is known as a trade. Or if you're a plumber, if you're carrying out your plumbing trade for your business, that's a trade. However, an investment company is one that has invested money. It might have property, it has other investments. So if you invest in stocks and shares and more than 20% of your income is coming from investments, then the company might start to be considered, or usually would be considered, as an investment company, which can have some negative impacts, especially if it comes to selling your trading company in the future. Because of this, if you were investing with a limited company, we would usually recommend that you set up a separate entity to focus on this, and you sort of keep the investment company separate from the trading company. Another sort of side consideration is that if you do have a successful investment portfolio, or let's say you invest in some property, if you're still linking that with your trading company, If there's ever an issue with the trade, let's say you're, as I mentioned, a plumbing company and one of your clients, you make a mistake and they sue you, then the assets, so the investment, can still be part of any settlement. So it's usually best to separate the assets so that they're in separate companies, just in case something bad does happen. Now, after hearing that, if you're still thinking about investing your company funds, you're probably asking yourself how to go about doing it. So first of all, you need to choose your investment entity. There are two primary ways you can invest your company's money into the stock market. Number one, you can invest it directly with your trading company, or number two, you can set up a separate company or an investment company. Once you've done that, you would issue what's known as an intercompany loan, which is basically a transfer between the two companies, and then you can invest the money. Although not required, option 2 is my general recommendation because it avoids some of the pitfalls highlighted earlier and also insulates the main trading company from the investment company. Before making any investment decision, I would strongly recommend seeking professional advice on your decisions. If you're a client and want to be introduced to a financial advisor, please drop me an email and I'll introduce you to one of our recommended partners. Regardless of the path you choose, or if you're just going to go down the DIY route, it's essential to minimize your trading costs when choosing an investment platform. For this, there are two primary platforms that I would recommend considering. Number one, Invest Engine. If you're keen on keeping costs low and enjoy buying and holding exchange traded funds or ETFs, then Invest Engine is likely an excellent choice. With incredibly low fees, this platform allows company accounts and has over 770 ETFs to choose from. There is no platform fee, there are no per trade fees, and there's typically no FX conversion. There are ongoing costs, also known as OCFs, but these depend on the ETFs or funds that you select. If you're interested in setting up a business account, you can go straight there using our affiliate link below. Please note that we do usually get commission with affiliate links, and the Invest Engine have not asked for us to post this video. It's all our own content and opinion. The second platform worth considering is Interactive Investor, also known as II. If you're looking for a large menu of investment options and prefer flat, predictable fees, then II might be the platform for you. Interactive Investor allows you to create a company account where you and up to 4 nominated individuals can invest in UK and international stocks, funds, ETFs and investment trusts. You will need to first open a general trading account and/or ISA, charged at the base platform fee, which is $4.99 a month. And once you've registered, you can bolt on the company account for £30 a month. It's worth noting that this £30 is a tax-deductible expense for your company, so it will reduce your corporation tax bill. Again, if you'd like to set up an account with Interactive Investor, please see our affiliate link below. As I mentioned, we do get affiliate commission from these, but neither II or Invest Engine have asked to be included in this content. What alternatives are there if your company has surplus cash? If the cash is genuinely surplus and unlikely to be needed as working capital, and by this we mean it might be needed in 3 months' time to invest in new goods, then you might want to think about investing in your director's or personal pension. Contributing to a director's workplace pension or a SIPP is a tax-deductible expense for a limited company, and so should reduce your corporation tax bill. Deposits are typically paid into your pension without incurring income tax or national insurance. Depending on your pension, any capital gains are usually then made tax-free. We'll include some links to SIPP providers and our blog post on SIPPs for you to think about below. The final alternative to invest in your company funds into the stock market is actually to invest it within itself. You can fund growth by investing in new team members or training for those teams, or you could also invest within yourself, providing yourself with training, purchasing new equipment, expanding product ranges, that sort of thing. I hope you found this video useful, and if you did, please drop a like, and if you've got any comments, questions or suggestions for what you think people should do with surplus funds, please leave them in the comments below. If you enjoyed the content, please consider subscribing. Thanks for watching, and I'll catch you in the next video.